So you can think about, because you are in different stages of your cycle, as we sort of looked at the first slide on where people are. I've sort of broken it into 4 different types of investors that are prevalent in the Indian market right now. This is outside of debt, by the way. So the first one are angel investors, and so angel investors in India will typically write checks anywhere between 10 lakhs to a crore. Some of the super angels are writing larger checks, but I really think of super angels in the family office bucket rather than as a angel. And so if you look at angels, angels in India are typically looking at a 2 to 3 year cycle in which the company scales to a certain level, and then they flip their stake to an investor like us coming in, or if a company is sold or whatever else, so that they have the capital freed up to make the next investment. So they are basically working on a 2 to 3 year cycle to keep recycling their investments. Okay, so that's how you have to look at an angel investor. The VCs that are investing in us, like us, investing in Series A and B, are looking at a 5 to 7 year horizon in that business to get to liquidity. And you're typically expecting a 25 to 30% IRR. Obviously want higher, but that's where you sort of end up. And liquidity for us would be through a strategic sale or through an IPO. If you look at the PE growth investors, they have shorter life cycle funds. Their funds are typically 7 year funds. VC funds are 10 year funds. And so they have a shorter period, could be a 3 to 5 year horizon. And they have a slightly lower threshold on returns. And then finally, the family offices and some large HNIs, as I mentioned, I've seen an interesting behavior that in some cases they are even open to dividend models. So they're not looking at an exit necessarily. They're saying if you can build a business which is scaling and so on, and you're paying us dividend, that's fine. It's effectively a higher yield asset class for them.